There is a window open right now for millions of Americans that will close permanently within the next 5 to 10 years. And when it closes, the people who did not use it will spend the rest of their retirement paying taxes they never had to pay. The window is the Roth conversion opportunity. And the reason it is worth $80,000, or more in many cases, is not complicated once you understand it. It is simply this. The money sitting in your traditional 401k or traditional individual retirement account right now is going to be taxed eventually. The only question is when, at what rate, and whether you get to control the answer to both of those questions. Most people let the IRS control the answer. They leave the money in the traditional account, they let it grow, and they wait. And then at age 73, the IRS says, time to pay. Required minimum distributions begin. The withdrawals are forced. The rate is whatever bracket you are in at 73, with Social Security income running and Medicare costs elevated. You pay what you are told. The Roth conversion strategy is about reversing that dynamic completely. It says, I am going to choose when I pay this tax. I am going to choose the rate. And I am going to do it now, during the lowest income years I will ever have in retirement, before the IRS forces my hand. In this video, I am going to show you exactly how to execute this strategy, the conversion amounts, the optimal years, the interaction with Social Security and Medicare that most people never model, and the specific scenario that produces the full $80,000 saving. And I want to flag something now. The most important concept in this entire video is not the Roth itself. It is the window. Understanding the window, and why it is time-limited for your specific situation, is what separates the people who use this strategy from the people who mean to use it and never quite get around to it. Let me start with the mechanics, because the strategy only makes sense once the underlying structure is clear. A traditional 401k or traditional individual retirement account works on a deferred tax basis. Every dollar you contributed went in before tax. Every dollar of growth has been sheltered from income tax. But every dollar you withdraw in retirement comes out as ordinary taxable income, at whatever your marginal rate is in the year you take it. The tax was never canceled. It was delayed. A Roth individual retirement account works on the opposite basis. Contributions come from after-tax money, no deduction going in. But the growth inside the account is completely tax-free, and qualified withdrawals are completely tax-free, forever, at any age, in any amount, with no required minimum distributions. Ever. A Roth conversion is the act of moving money from the traditional account, where it will eventually be taxed, into the Roth account, where it never will be again. You pay income tax on the amount converted in the year you converted. That is the price. In return, every dollar that lands in the Roth grows tax-free and withdraws tax-free for the rest of your life. The question that determines whether this is worth doing, and how much to convert, is simple. What rate do you pay now, and what rate would you face later if you leave the money where it is? If the answer is that you pay a lower rate now than you would face later, every dollar converted is a dollar that saves you the difference in rates permanently. And for a large number of Americans approaching or recently in retirement, that difference is very real and very large. Here is where the $80,000 figure comes from, and I want to walk through this precisely so you can see whether the numbers apply to your situation. Take a married couple, both recently retired, ages 63 and 61. They have $850,000 in traditional individual retirement accounts combined. They have $95,000 in a Roth individual retirement account. Their Social Security retirement income will start at $67,000, combined benefit of approximately $44,000 per year. Their living expenses are $68,000 per year. For the 4 years between now and when Social Security begins, their taxable income is almost entirely within their control. They need $68,000 per year to live on. They have no other taxable income. After the standard deduction of $32,200 for married filing jointly in 2026, they have access to the entire 12% bracket, which runs to $100,800 of taxable income, plus the 22% bracket up to $211,400. Their strategy: draw $68,000 per year from the traditional individual retirement account to cover living expenses. Then convert an additional $95,000 per year from the traditional individual retirement account to the Roth, filling up to the top of the 22% bracket in each year. Tax on the total $163,000 withdrawal in year 1. The first $32,200 is covered by the standard deduction. The next $68,800 in the 10 and 12% brackets, approximately $8,000. The remaining $62,000 in the 22% bracket, approximately $13,640. Total tax, approximately $21,640, of which the portion attributable to the conversion, approximately $13,640. They pay that conversion tax from savings outside the individual retirement account, not from the individual retirement account itself. This is essential. Every dollar withheld from the conversion to pay tax is a dollar that does not land in the Roth and does not compound tax-free. They do this for 4 years. 4 years of conversions at 22% or below. Total converted, approximately $380,000. Total conversion tax paid, approximately $54,000 to $60,000. Now compare that to leaving the money untouched. From age 73, required minimum distributions begin. The traditional individual retirement account, which has continued growing, now has a balance of approximately $720,000. The first required minimum distribution is approximately $27,000. Combined with Social Security of $46,000 at that point, with several years of cost of living adjustment increases applied, total income is $73,000. After the standard deduction, taxable income is $40,800, 22% bracket. By age 78, the required minimum distribution has grown to approximately $38,000. Total income, $84,000. Taxable income, $51,800. The 22% bracket is full, and they have crossed into the 24% bracket. By age 82, required minimum distributions are $48,000. Total income, $94,000. Firmly in the 24% bracket with a meaningful portion approaching the 32% threshold. Total federal income tax from age 73 to 85 in the no conversion scenario, approximately $135,000. Total federal income tax from age 73 to 85 in the conversion scenario, where the traditional individual retirement account balance at 73 is $370,000 rather than $720,000, generating smaller required minimum distributions, approximately $55,000. The difference, approximately $80,000 in lifetime tax savings, from 4 years of deliberate conversion at low rates during the window. But the $80,000 figure understates the full benefit when you add 3 more dimensions that the simple comparison leaves out. The first is the Social Security tax interaction. Up to 85% of Social Security retirement income becomes taxable once provisional income exceeds $44,000 for married couples. Provisional income includes adjusted gross income plus half of Social Security. In the no conversion scenario, the large required minimum distributions at 73 and beyond push provisional income well above the threshold in every year, meaning the full 85% of Social Security is taxable throughout. In the conversion scenario, smaller required minimum distributions keep provisional income lower in more years, reducing the taxable proportion of Social Security and saving additional tax on top of the bracket saving. The second is the Medicare income-related monthly adjustment amount. Medicare premiums are income-tested 2 years in arrears. Large required minimum distributions in the 70s push more years over the income-related monthly adjustment amount threshold, generating elevated Medicare Part B and Part D premiums year after year. Smaller required minimum distributions from a lower traditional individual retirement account balance keep more years under the threshold. Over 10 years of Medicare, the premium saving alone can be several $1,000s. The third is the inheritance dimension. Every dollar remaining in the traditional individual retirement account at death is inherited by beneficiaries as ordinary taxable income, distributed over 10 years at their marginal rates under the current inherited individual retirement account rules. Every dollar remaining in the Roth individual retirement account at death is inherited tax-free. For beneficiaries in the 24 or 32% bracket, the difference between inheriting a $300,000 traditional individual retirement account and a $300,000 Roth individual retirement account is $72,000 to $96,000 in tax. The Roth conversion strategy is simultaneously retirement tax planning and estate planning. Now let me give you the framework for executing this, because the principles are clear but the execution requires annual precision. The Roth conversion strategy is not a one-time event. It is an annual exercise, run at the start of each tax year, recalibrated to your current income picture and sized to fill your target bracket without crossing the next threshold. At the start of each year, the calculation works like this. Add up all your projected fixed income for the year. Social Security, if it has begun, any pension income, required minimum distributions if they have started, investment income you cannot control. That is your income floor. Calculate the gap between your income floor plus the standard deduction and your target bracket ceiling. In 2026, for married filing jointly, the top of the 22% bracket means taxable income of $211,400, gross income of $243,600 before crossing into 24%. The gap between your income floor and that ceiling is your conversion capacity for the year. That is how much you can move from the traditional account to the Roth at 22% or below. Then check 3 guardrails before committing the conversion amount. First, the Social Security Provisional Income Threshold. If Social Security has already started, converting too much can push provisional income above $44,000 and make a larger proportion of Social Security taxable. Model the interaction before finalizing the amount. Second, the Medicare Income-Related Monthly Adjustment Amount Threshold. For married couples in 2026, the first surcharge tier begins at $212,000 of income. Converting up to but not over that threshold protects 2 years of future Medicare premiums. A conversion that crosses the threshold by $5,000 can cost $1,800 in additional Medicare premiums 2 years from now. Third, pay the conversion tax from outside the individual retirement account. Using individual retirement account money to pay the conversion tax reduces the amount that lands in the Roth, reduces the tax-free compounding, and may, if you are under 59.5, trigger the 10% early withdrawal penalty on the tax withholding. Always fund the tax bill from savings, brokerage accounts, or other non-individual retirement account sources. The Roth Conversion Modeler Inside Retirement, Ready US, calculates your optimal annual conversion amount for each of these guardrails simultaneously, showing you the conversion ceiling, the tax cost, the projected reduction in future required minimum distributions, and the estimated lifetime tax saving in a format you can model and adjust before committing. Link is in the description. There are 3 situations where the Roth conversion strategy is most powerful, and if you fall into any of them, the case for acting now rather than later is particularly strong. The first is the early retiree with a large traditional individual retirement account. If you retired between 60 and 65 and have not yet claimed Social Security, you are in the highest value conversion window of your entire retirement. Your income is low. Your bracket is effectively empty. The cost of converting at 12 or 22% today versus paying 24 or 32% on required minimum distributions at 73 is the full difference, every year, for the rest of your retirement. This window closes when Social Security begins and narrows further when required minimum distributions start. The people in this situation who are not converting are paying a very high price for inaction. The second is anyone with a traditional individual retirement account balance above $500,000. At that balance, the required minimum distribution at 73, on a pot that has continued growing, will be substantial. Combined with Social Security, it will push many households into the 24% bracket or above from the very first year of forced distributions. Every year of conversion before age 73 reduces that eventual balance and the tax rate that will be applied to it. The third is parents with adult children in higher tax brackets. If your beneficiaries are in the 24 or 32% bracket, as working professionals often are, the Roth conversion strategy doubles as inheritance planning. You convert at 22% now. Your children inherit tax-free rather than paying 24 or 32% on distributions over 10 years. The combined household lifetime tax saving across both generations can significantly exceed the $80,000 figure in the title. Let me bring this back to the window. The Roth conversion opportunity does not disappear at a fixed date. It does not close with a single deadline. It narrows gradually, as Social Security begins, as required minimum distributions start, as income from other sources accumulates, as the years of low taxable income in early retirement give way to a more crowded income picture. For a 63-year-old who has just retired, the window may be 5 to 8 years wide. For a 70-year-old who has recently claimed Social Security, it is narrower but not closed. For a 73-year-old with required minimum distributions already running, it is narrower still. But the strategy still applies to the Roth capacity that remains available above the required minimum distribution floor. The question is not whether to convert. For most people with significant traditional account balances, the maths say yes. The question is, how much, at what rate, in which year, and whether you are calculating that number deliberately or leaving it to default. Run your own numbers using the Roth Conversion Modeler Inside Retirement Ready US. It models your specific traditional account balance, your Social Security timeline, your current bracket position, and the projected required minimum distribution trajectory, and shows you the lifetime tax saving from different conversion strategies applied to your actual situation. Link is in the description. I have also linked the required minimum distributions deep dive and the Social Security timing video below. Together with this one, they give you the complete picture of how these three decisions interact. Hit like if this was useful. Subscribe for more U.S. retirement planning content. I will see you in the next one.